Myself, Dr. P.T. Gandhimadi, Head and Assistant Professor of Commerce Computer Applications. In this video, we are going to discuss about the marginal costing. What do you mean by marginal costing? Marginal costing is the ascertainment of marginal cost and the effect of profit on changes in volume or type of output by differentiating the cost into fixed and variable. The other names for marginal costing is direct costing, variable costing, incremental costing. Marginal cost. What do you mean by marginal cost? The cost, that is the amount at any given volume of output by which the aggregate of cost are changed if the value of output is increased or decreased by 1 unit. If we are increasing the output, there is a change in the price, that is the cost. That cost is called marginal costing. Features of the marginal costing. The main feature of the marginal costing is the cost is classified into variable and fixed. Variable cost only treated as the cost of the product. In marginal costing, we are treating the variable cost as the cost of product. Then stock and work in progress are valued at marginal cost. What do you mean by work in progress? It is a semi-finished goods. Then fixed costs are charged against contribution only. The prices are based on the marginal cost plus contribution. Merits. By using the marginal costing techniques, the management have to take decisions with regard to price fixation, accepting foreign orders, make or buy decision, the product mix. What do you mean by product mix? Suppose we produce 4 products, then what is the combination of product A, B, C, D? This is the product mix. Then another advantage is the better result when compared to standard costing. Then effective cost control is possible through the marginal costing. It avoids over recovery and under recovery of costs. The inventory valuation is more realistic in the marginal costing. There is no false profit. Then it is also very useful for the study of relative profitability of different products. With regard to the demerits, it is not easiest task to divide the cost into fixed and variable cost. There are semi-variable costs also. Then it ignores the time element. Long run fixed cost changes according to the marginal costing. Then under recovery and over recovery cannot be eliminated in the marginal costing. Under recovery of cost or over recovery of cost cannot be eliminated here. Then it tries to specification and comparison cannot be done without considering fixed cost. In every business there is a large amount of fixed cost, but in marginal costing we ignore the fixed cost. We are considering after the contribution. So fixed cost is a must one, but we are not considering this fixed cost. Then valuation of inventories using marginal costing is not accepted by the tax authorities. The tax authorities is accepted only the market price or cost price whichever is less. Then marginal cost statement. The main important point is here the statement. It consists of sales minus variable cost. It comes contribution. Then after the contribution we have to deduct the fixed cost, that is the profit. Okay, break-even point analysis. We have to discuss about some points related to the marginal costing, some concepts. Break-even point analysis, it is shortly known as BEP, or another name is CVP analysis, that is cost volume profit analysis. In a narrow sense, we are discussed that total revenue is equal to total cost. So there is no profit, no loss. So break-even point, it is a point at which there is no profit, no loss. In broader sense, the probable profit at any level of output can be determined. Then assumptions. We are considering some assumptions. Already in marginal costing, we are classifying the cost into fixed and variable. Right? Then second assumption is fixed costs remain constant. That is, for example, if we paid rent for the building, in every month the same amount is paid. So we have to assume that fixed costs are constant. At the same time, the variable costs are vary with the volume of output. For example, if the variable costs consist of mainly direct material, direct labor and overhead. For example, direct material. If we need 2 products of A, 3 products of B for producing product X, the mix, we have to add for 1 product 2 products of A, then 3 products of B. We have get 1 product of X. Suppose if we need 5 products of X, then we need 5 into 2. Product A need 10, then product B need 15. So according to that, the cost is changed. That is called variable cost. Then at the same time, the selling price per unit is constant. We have to assume selling price per unit is constant. Then at the same time, we have to assume that there is no change in operating efficiency, there is no change in general price level, then only 1 product or sales mix remain constant, then volume of sales and production are equal. The volume of sales, that is, whatever we produced, we are selling that product. For example, 100 units we produced, then we sold all 100 units. That is the assumptions here. Then terms. The main term is fixed cost and variable cost. Fixed cost. What do you mean by fixed cost? The cost which is not vary with the volume of production. For example, salary, rent, insurance. The amount is always constant up to the certain level of plant capacity. Then it is very useful for price fixing policy. Then variable cost. It is a vary in the volume of production or sales. Example, electric power, fuel. Already I told that direct material, direct labor, then direct overhead. This is per unit is constant. Total amount is vary. Then contribution. What do you mean by contribution? Sales minus variable cost is the contribution. The other one, fixed cost plus profit, is called contribution. This contribution is used for sales and pricing policies. If we want to fix a price, then we have to use the contribution. Then the contribution is also used to measure the profitability of the business. Then test product is worthwhile to be continued. For example, if you make a product and send to the market for sale, and afterwards we get the reviews from the customers, and we have to make certain modifications in the product. So test products, for that the contribution is the very useful one. Then next term, margin of safety. The name itself describes that safety level of the production. It is always expressed in percentage or sales. Sales reduced without the loss, that is, the margin of safety is the level where there is no loss. Then it describes the soundness of the business. The formula for calculating the marginal safety is sales minus break-even sales or profit divided by PV ratio. PV ratio means profit volume ratio. Then the margin of safety can be improved. How? By increasing production, increasing selling price, reducing fixed and variable cost, then substitute the unprofitable with the profitable one. Substitute the products which are profitable and unprofitable, we have to classify it and substitute the unprofitable product with the profitable one. Then angle of incidence. Angle of incidence means the angle between sales line and the total cost at break-even point. In the break-even point, the sales line and total cost, that is called angle of incidence. It indicates what? The profit earning capacity of the business. If it is a large one, angle of incidence is a large one, there is a high rate of profit, and if it is a small one, there is a low profit. Then it improved by increasing the contribution, then increasing the selling price and reduce the variable cost. Angle of incidence indicate that the output and sales price changed to attain the amount of profit. If you want to attain certain amount of profit, then we have to consider the angle of incidence. Then PV ratio, that is profit volume ratio. It is always expressed in percentage. The formula for this is contribution divided by sales into 100. It can be improved, that is PV ratio can be improved by reducing the variable cost or increasing the selling price per unit. The main help of the PV ratio is to determine the break-even point and profit at any volume of sales and sales to earn desired profit. Then break-even point by divide equal position. Break means divide, even means equal, point means position. There is no profit, no loss. Break-even point means there is no profit, no loss. At which point there is no profit, no loss, that point is called break-even point. This is the minimum point, that is total costs are recovered. Then if the sales is go up, there will be a more profit. If the sales is go down, there will be a loss. The formula for sales to earn desired profit is, if we want to calculate in units, fixed expenses divided by contribution per unit. If we want to calculate in rupees, fixed expenses divided by contribution into sales. Thank you.